Last month, I covered the Silicon Valley Bank failure, but the hits just keep on coming. Next, it was Signature Bank in New York, followed by First Republic Bank in San Francisco. In terms of assets and adjusting for inflation, the sum of the three bank failures that we've had this year is greater than the sum of all 25 bank failures during the Great Financial Crisis. And it looks like PacWest may be next. So if you're banking with a small or regional bank, should you take all of your money out and move it to a bigger bank? Well, probably not. The situation that we're seeing right now is much different than it was back in 2008, 2009. Back then, all those subprime loans were sausaged together into investments that were eventually given credit ratings of AAA, so no one knew who had what. Throw in a few credit default swaps and voila, the entire system seizes up. No, what we have today isn't so complicated that it requires a bubble bath explanation from Margot Robbie. The banks that are failing today are just bad at banking. They invested a lot of their deposits into long-term treasuries, and normally that wouldn't be a bad thing, until interest rates started rising like they did last year. Because when interest rates rise, bond prices fall. During the course of normal business, some of these banks had to start selling these long-term bonds at a loss. To shore things up, they went out and raised funding, which caused some of their big depositors to freak out. And there's your bank run. So now that all of this has been in the news, any bank with a janky balance sheet is at risk. On top of this, small and regional banks need to offer more competitive rates to attract or keep their customers. Now, sadly, this squeezes their margins when big banks are only offering 0.01% interest on their savings accounts. This puts more pressure on these smaller banks, even the ones with sound balance sheets. But this big old mess affects depositors less than the people who own the bank's stocks. So while some of these regional bank stocks may be down, they could very well have healthy balance sheets and be in no jeopardy of failing. It's important to note here that, as of right now, no depositors have lost any of their deposits. So should you give up on your small bank, regional bank, or credit union? Not necessarily. These banks typically have lower fees, pay more in interest, and frequently have better service. There's still an important role for them to play within the communities that they serve. Now, if you're still thinking about changing banks, there are a few things to consider. First is to never exceed the FDIC deposit insurance limit with any bank. The general rule is that $250,000 per depositor is covered. Now, I've created a video that shows you how to get more than that, and I'll post a link in the show notes below. Next, if your bank does end up being acquired, such as First Republic, which was purchased by JP Morgan, you may not notice any interruption at all. The logo on your statements will change, but business will go on as usual after the acquisition. Now, if something crazy happens with your bank and the FDIC has to step in, there may be a few days that you may not have access to your funds. But as long as you're under those insurance limits, there's no need to stress. The FDIC is going to do everything it can to act fast and give everyone confidence in the banking system. If you still find all of this too stressful, then maybe a big bank is a better option for you. They're certainly more convenient, well, until you actually have to talk to a human. You may not quite get the same interest rates, but then again, your peace of mind is actually worth something too. There's another option for you to consider as well. Remember, your brokerage accounts are protected too. Instead of the FDIC, SIPC insures up to $500,000 of your investments and up to $250,000 in cash. Of course, this protects investors in the case of a brokerage firm going under, not an investment loss. Investing in some short-term treasuries could be an interesting alternative with some decent yield now that rates have gone up. But be careful going on a quest to find more yield. As Raymond DeVoe said, more money has been lost reaching for yield than at the point of a gun. So be careful. So if you hear more about this banking crisis in the news, just realize that it's the stockholders of those banks that may have the most at risk here. In cases like this, another bank will step in and buy their business at a nice discount. Now, if depositors start losing money, then we have a problem. But we're nowhere close to that right now. If you're going to call what's happening right now a banking crisis, it's more of a crisis for the banks themselves and their shareholders. The depositors can sleep well at night for now. Now, if you'd like to know how you can have up to $3.5 million at one bank and still have the entire amount FDIC insured, I recommend that you watch this video to learn more. I'll see you there.